Nil Limited and Gagan Limited amalgamated to form a new company on 1st April 20x1. Following is the draft balance sheet of Nil Limited and Gagan Limited as at 31st March 20x1. See, Nil and Gagan, they will be amalgamated to form a new company. This new company is the purchasing company. Otherwise, Nil as well as Gagan, both are selling companies. So we are having two selling companies this time. And for both the two companies, you will have to find out the purchase consideration. Balance sheet has been given to us, fine. Then they are saying following is the additional information. The authorized capital of the new company will be 25 lakhs divided into 1 lakh equity shares of rupees 25 each. Fine. Liabilities of Nil Limited includes 50,000 due to Gagan for the purchases made. Gagan Limited made a profit of 20% on sale to Nil Limited. Fine. Nil Limited had purchased goods costing rupees 10,000 from Gagan. All these goods are included in the current assets of Nil. Fine. Assets of Nil Limited and Gagan Limited are to be revalued as follows. So new values of plant and machinery and building is given. Purchase consideration, yes, that is what we are interested in. They are saying purchase consideration is to be discharged as under: issue 24,000 equity shares of rupees 25 each fully paid up in the proportion of the profitability in the preceding 2 years. And then they have given you the profitability. So 4,75,000 and 5,25,000. So in this ratio, 24,000 equity shares will be distributed between Nil and Gagan. Information C, they are saying issue 12% preference shares of rupees 10 each fully paid up. So our preference shares will be at 12% to provide income equivalent to 8% return on net assets in the business as on 31st March 20x1 after the revaluation of assets of Nil and Gagan. Revaluation of the assets. Here it is. Plant and machinery and the building, right? These are the revalued figures which are given. We should consider that. On the basis of that, we should work out the net assets. By net assets, we mean assets minus liabilities. On those net assets, we have to find out that what will be the income at 8%. And this income at 8%, we will satisfy by issuing our preference shares at 12%. Very interestingly given. They are saying you are required to compute the equity shares and preference shares to be issued and the purchase consideration. So part one is to determine equity shares and preference shares to be issued in number, while part two will give us the purchase consideration. What we are paying to equity shareholders and the preference shareholders in value, that sum total will be the purchase consideration, while part one will provide us only the number of equity and preference shares. Let's use information 5A and get the 5A and B and get the equity shares. Total equity shares we know 24,000, and we will distribute that in the ratio of the profitability. And in 5B itself, the profitability is given. So it's not that difficult to get the equity shares. So I like to solve for part one. Calculation of equity shares to be issued. Right, equity shares to be issued. In a new line in center, I say 24,000 shares. Nil Limited and Gagan Limited. It will be 24,000 shares in two. The profitability of Nil is 4,75,000. And the profitability of Gagan is 525. 475 plus 525, it is turning out to be 10 lakhs. Here also I'll say 24,000. The profitability here is 5 lakh 25. This is 5. Okay, 5 lakh 25 divided by 10 lakhs. Great. Determine this. You will end up issuing 11,400, and here 12,600. So that is the issue of the equity shares. Continue with part 1 itself. We now say calculation of preference shares to be issued. Preference shares to be issued. Again, if we check with information 5C, right, this is the information. We will issue our 12,000 preference shares, 10 rupees each at par. We have to issue preference shares in such a way that we can provide 8% return on net assets. And remember, net assets is assets minus liabilities. And for assets, they are saying that do it after the revaluation. Here are the revalued figures. Okay, so we'll use those revalued figures and calculate the same. Yeah, you may also wonder that are we supposed to give any effect for information 2 and 3? See, they are saying liabilities, information 2, liabilities of nil includes 50,000 due to Gagan. See, the two companies are having some mutual obligation. But right now I am calculating what are the net assets of Nil and Gagan. Right now the two companies are separate companies. So I should not give any effect of information 2 right now. So I will ignore information 2 right now. Then in 3 they are saying Nil had purchased goods costing rupees 10,000, and then they are saying that these goods are lying in the current assets. Fine. Right now, Nil and Gagan are two separate companies. I will also ignore this information. See, all this information is to be considered only when Nil and Gagan become a single company. Right now, the two companies are separate companies. So we will ignore these information. So let us prepare a proper table and do our calculations for the two companies, Gagan and Nil. Let us start with the net assets calculation. So I start with plant and machinery. I pick up the figures which they have given in the question, the revalued figures. Then we have building. Yes. Apart from this, what do we have in the balance sheet? You can see in the balance sheet, plant and machinery considered, building considered at the revalued figures. We now have current assets 163,500 and 158,600. Okay. Current assets 163,500, 158,600. We leave a line right now for the intermittent total. From this, we will have to deduct the liabilities. Let's return back to the question again. Current liabilities. That's all that we have. Okay. So let's current liabilities. 623,500 and 557,600. The difference between these two will be net assets. Thus, I will multiply with the desired return. Right? We want to provide them 8% return. So this is going to be the expected income. Okay. And we have to provide this expected income by issuing our preference shares at 12%. So this we will say divided by preference dividend rate. Our preference dividend rate is 12%. This will give you value of preference shares. We will issue our preference shares at face value of 10. Okay, we will issue our preference shares at face value of 10. This is what will give you number of preference shares. We have prepared the entire format that how we can reach up to the number of preference shares. So let us do this. 525, 7,75,000, 163,500. I get 14,000, 63,000, 14 lakhs, sorry, 14 lakhs 63,500. 623,500 I'm deducting. My net assets are 8 lakh 40. I have to provide 8% income. So I have to provide 67,200. And I will provide this by issuing my preference shares at 12%. So I divide by 12%. Right? So 67,200 divided by 12%, I get 5,60,000. If you issue preference shares of 5,60,000 at a 12% dividend rate, you will be able to provide that 8% return. Number of preference shares issued will turn out to be 56,000. Same way, we would like to do it for Gagan. 675, 648, 158, 600. It is 14 lakhs 81,600 minus 557,600. So it is 9 lakhs 24,000. 8% is the income that I will like to provide. So that is 73,920. So what should be the face value of preference shares so that I can provide 73,920 of income? It should be 6,16,000. So 61,600, that is the number of preference shares that I should be issuing. So yes, if you want to have a good look at this answer, here it is. You can pause the video here. If this is what you have already written, here is the rest of the answer. You can pause the video here. So now I know the number of equity shares to be issued and the number of preference shares to be issued. We have to now simply multiply that with the value at which you are issuing. It will give you the purchase consideration. So it is time to get the purchase consideration. Here there are 11,400 shares. The shares we are issuing at 25 rupees. Two lakh 85,000. It is 12,600 shares at the rate rupees 25. 3 lakh 15. Preference shares. $56,000. Just writing it directly at the rate rupees 10. 5 lakh 60. 61,600 preference shares at 10. 6 lakh 16. Take a total. 8 lakh 45,000. 9 lakh 31,000. That's your purchase consideration. Right. And pause the video and complete.